Very good morning, friends. So I hope you're doing well and saw the concept what we covered in Ind AS part number one. So I'm going to continue with the second part of Ind AS 2 with you, which is, of course, dealing with inventory. And today, in fact, I have to take up some very interesting issues with you. And let me first, I think, let's take a quick recap in terms of what we have discussed so far. And then I think we're going to take the journey forward. So, we had a discussion so far on Ind AS 2 in terms of understanding the definition of inventory. We had a focus on the word assets. Just to remind you that asset under the framework is defined as comprising of two important aspects. One is future economic benefits being probable, and the other is in terms of control, where you have either a legal ownership or the right to restrict others from use. Then we saw that inventory would comprise of finished goods as well as WIP and raw material. And we also took a little clarification in terms of material would include what kind of material. Of course, raw material, but then we looked into the clarification of packing material. If it is primary, it is taken. If it is secondary, it's not taken. And if it is a publicity material for advertisement, then also it is not taken. Then we went ahead with the measurement principles, and we had a complete picture in mind that we're looking at para number 9 read with para number 32, which gives us the measurement principles for inventory valuation. We saw that para number 9, which talks of cost or NRV, is applicable to WIP and FG. But when it comes to raw material, which is used for production, consumed for production, then para number 32 applies. Wherein we saw that the valuation of the raw material is completely dependent upon the valuation of the FG. If the FG is taken at cost, raw material is also taken at cost. But if the FG is taken at NRV, then raw material is taken at cost or NRV, which rather I would say cost or replacement cost, whichever is less. Then we went ahead on the next aspect, that is the third aspect of Ind AS 2, where we saw the concept that what is taken in cost. Rather, we said we segregated the cost in three different portions. What is included in inventory, that's technically called a product cost. What is excluded from the inventory cost is technically called the period cost. And then there is another category of cost which may or may not form part of the inventory, and that is borrowing cost, which is totally dependent upon the application of Ind AS 23, whether the inventory is a qualifying asset or not. If it is, then the borrowing cost is included, otherwise not. Now, this is what we had a journey, and we did a couple of questions on that. Now, before I take you further, we are now going to discuss today some more special issues related to the concept of cost. I have on the agenda today, three special issues related to cost in my mind. One is when the inventory is acquired on a deferred credit, then how does the accounting take place? Because this is one area where accounting standard 2 was completely silent. The another very interesting area which has got a little blend in terms of cost accounting is looking at the treatment of joint and byproducts. So I think I'm going to take you back to the memory lane of CA Intermediate, where you did the chapter on joint and byproducts. So we're going to draw attention to those concepts as well. I know you must be saying, sir, I don't remember what we did in that chapter at that stage." Don't worry, I'm here to recollect in terms of what you've done. And then the third aspect, which I'm going to cover in terms of cost, is the cost formulas. That when you consider the inventory, then what kind of cost formula is to be applied? Are we using a first in, first out? Are we using a weighted average, or any other cost formulas which might be applicable? So today we've got three focus points of discussion. One is dealing with the deferred credit, one is dealing with the joint and byproducts, and one is dealing with the cost formula. Thereafter, we're going to go to the next section, which is the last section of the standard, and that deals with the concept of net realizable value. So I think let's begin the journey. And as we are in a habit, we're going to first read a few things related to these special issues in the text of the accounting standard. So I think let's begin with first of all the para number 18. The first issue I'm dealing with is para number 18. In para number 18, it says an entity may purchase inventory on deferred settlement terms. So it says that entity may purchase inventory on deferred settlement term when the arrangement effectively contains a financing element, that is interest. That element, for example, a difference between the purchase price for normal credit terms and the amount paid is recognized as an interest expense over the period of financing. Well, I think what we might have understood so far is that he's talking of a difference between the amount paid and the purchase price, which is for a normal credit term. The difference between the purchase price and the amount which is paid is considered to be an interest, which it says is recognized over the period of credit. I think let's take an example to understand the application of para number 18. Now, I think let's take a small little example to illustrate this to you. Let's say, for example, if I were to purchase inventory, let's say outrightly on the basis of cash. So let's say the inventory would have been bought at, let's say, a cost of 1 lakh. So if you would have bought the inventory on normal credit terms, mind the word, normal credit terms, let's say if the supplier says, I will allow you a period of 2 months to pay. So that is supposed to be a normal credit term. So he said, if you pay me within the normal credit period of 2 months, you can buy this inventory at 1 lakh. But I said, okay, can you allow me more time to pay this money? So he said, okay, if you want to take more time, let's say I'm going to ask you to pay this money after 2 years. So you pay the entire money at the end of 2 years. So he said, if you want to pay the money at the end of 2 years in lump sum, then I'm going to charge you, let's say 1,21,000. Now, if you look at the language which is used in para number 18, it very clearly says the difference between the amount paid. Now, in my example, what is the amount paid is 1,21,000. And it says the difference between the purchase price on a normal credit term. In my example, if you buy it on a normal credit term, that's 1 lakh rupee. So we can say the difference 21,000 is nothing, but you can say it is supposed to be the interest. It is supposed to be the finance charge, the finance cost, or the interest which is going to be spread over the period of 2 years. So this interest is going to be spread over the period of credit. That means we're going to spread it over a period of 2 years. Now, let me also add a few technical terms to this concept. In Ind AS, you will quite often hear from me in these classes that I'm going to use the word called unwinding of discount. Yes, I think you heard it correct. It is called unwinding of discount. Now, what is unwinding of discount? Let's have a look at this example to understand how the unwinding of discount is done. Now, I think what I need to do, first of all, I need to give you the interest rate. So let's say in my example, the interest rate is at the rate of 10%. So when I'm going to record the purchase of the inventory at 0 point of time, then I will take the present value of 1,21,000. So if I calculate the present value, if I calculate the present value of 1,21,000, I will take the interest rate as a discount rate, which is 10%. So we'll take 1 divided by 1 raised to power 2 years, because you're going to pay this money at the end of 2 years. So if I divide this 1,21,000 by 1.1 raised to power 2, you get the same figure, which is 1 lakh. Oh my God. You must be wondering, sir, have you intentionally ensured that the present value of 1,21,000 comes equal to 1 lakh? Of course, I've done that. But trust me, When you go to take the present value of the amount paid, the present value of the amount paid would certainly match the figure of 1 lakh rupees as well. Because at the end of the day, when you say that if you bought the inventory today at a normal credit terms, you pay 1 lakh rupees. So if you're paying that excess of 21,000, this is being paid because the supplier allows you a deferred credit term. Now let's see what kind of journal entries are we going to pass over a period of 2 years in this particular case. So let's have a look at the journal entries with you, the application of para number 18. So let's say I am sitting at the beginning of year one. I'm sitting at the beginning of year one. So let's see what entry are we going to do at the 0 point of time. That's beginning of year one. So you would pass an entry purchase account debit. And since we've not paid any amount of cash, we can easily create a creditors. And this entry is going to be done with 1 lakh rupees, which I would have paid if I would have purchased on a normal credit terms. Now, what we're going to do at the end of year one, this is the entry at the beginning of year one. Now, let's see what we're going to do at the end of year number one. Now, at the end of year number one, you need to consider this 1 lakh rupees as a loan. Consider this 1 lakh rupees is like an outstanding loan and you calculate a 10% interest on the same. Now, when you go to calculate a 10% interest, the entry would become finance charge account debit. You can call it as an interest. You can call it as a finance charge, though I think technically the word finance charge is more appropriate, even if you look at the language in terms of Schedule 3. So we'll calculate a finance charge and this amount is payable to the creditors. So on 1 lakh rupees, if you consider 10% interest, that works out at 10,000. This is exactly what we call unwinding of discount. Now, if you look at this in a very logical flow, what you did, first of all, you took the present value of 121. So what we did, 121 is a future value. So you took the present value, you did a discounting. Now, what are you doing? You are doing a compounding. That's what we're doing. So first of all, 121 was discounted and now we are getting this 1 lakh rupees and we are taking a compounding, and that's called unwinding of discount. So does that mean that the concept of unwinding of discount is like, compounding the same values for which we took a present value? Exactly. If you say that first you did a discounting and then you say you did a compounding, then that compounding is technically called unwinding of discount. Now, a similar entry would be done at the end of year two as well, but of course with a different amount. So what are we going to do at the end of year number two? At the end of year number two, we'll do the same entry. So I think let me just put it like this, saving a little time on that. So now when you calculate the interest, you need to calculate the interest on the total outstanding 1 lakh rupees plus the 10,000 interest. You take a 10% on the total outstanding and that works out at 11,000. And now you can see very clearly that the creditors in the books of account is standing at 1 lakh 21. 1 lakh rupees in the original entry at the beginning of year one, then another interest of 10,000 and 11,000 makes it a cumulative total of 1 lakh 21. And then at the end of the second year, when you go to pay this money to the creditors, the entries would become creditors account debit to bank. Creditors to bank or cash, whatever the case might be, we pay the entire 1,21,000. So you can see one thing very clear in this particular example, that at the end, the purchases, if you notice, stands in the books of accounts at 1 lakh. The inventory, which is represented by the purchase, is recorded in the books of accounts at 1 lakh itself. It is only that the concept of unwinding of discount is being applied to the creditors because you need to pay them a lump sum of 1,21,000 at the end of the second year. So as I said, all this concept is technically called unwinding of discount. So are we supposed to know the terminology, unwinding of discount? Well, I think if you know it's, then I think it's good. And trust me, as we could go to many standards, like even Ind AS, 37, Ind AS 16, or Ind AS 38, you going to hear this term again and again. So it will become a part of your language itself. So you don't need to apply a very conscious effort in terms of remembering this terminology. I think it will certainly flow out of this. Many a times people tell me that when I speak to them also, they say that your language seems to be very accounting in a journal life as well. So I think it happens that when you're involved with a particular things all throughout your day, it becomes a part of your blood as well. So whenever you speak to someone also, that natural flow in terms of things comes. So I think by now you would have understood the concept of unwinding of discount. Okay, now I think we need to make some notes on the special issue. So what I'm going to do, we were talking on the section number 3, and in the section number 3, as we said, we were talking in terms of the cost. So what we're going to do, we're going to number special issue number 1. So in my third section, we're going to call this as special issue number 1. I'm also in a habit of doing certain things which I'll tell you right away, but of course we're going to do that later. And that is making some mind maps also. So like for example, if it is a simpler standard which doesn't take much, many classes to finish, then what we can do towards the end is, I generally create a mind map binding you in terms of the flow of the standard, putting down all the critical things in that, so that it becomes very helpful immediately before the exams, that you can just look at that mind map and it reminds you all the technicalities related to that particular index. Well, of course, in bigger standards also, we are going to make the mind maps, but we can't wait for the entire standard to get over. So we're going to make some mind maps in between, as a couple of subsections would get complete. So I think that would also be, very helpful immediately before the exams, because it's very difficult to recollect all the nitty-gritties you've done in each standard. So you need some kind of, condensed notes as well. Okay, so that's going to be a more of a constructive obligation from my side. Now, if you're thinking what is a constructive obligation, wait for Ind AS 37. You'll understand that term as well. Okay, so when I'm looking at the special issue number 1, I'm looking at the deferred settlement terms. We're looking at the deferred settlement terms. Okay, so we're looking in terms of the special issue 1, that is deferred settlement terms. So deferred settlement terms. And what we need to remember in terms of the deferred settlement terms is something very simple, that we can first of all consider that we need to get the finance charge. And what is that finance charge? You need to compare the difference between the amount paid minus the purchase cost on normal credit terms. Mind the words, it says normal credit terms. So in my example, the normal credit terms means the purchase cost is 1 lakh and the amount paid is 121. So this finance charge is going to be spread. This finance charge is going to be spread over the period of credit. So this is going to be spread over the period of credit. So it could be 2 years or whatever. And we can just add on that we need to technically apply the concept of unwinding of discount. So we can just put a note out here. Technically, so we can say technically Now you must be wondering why there is a triangle. I think sometimes it picks it on its own. I have no specific intentions of making triangles on that. So technically applying unwinding of discount concept. Technically applying the unwinding of discount concept. Okay, so I think that takes care of my special issue. You must be wondering, sir, any practical questions on this area in the assignment? Well, unfortunately, there has been no question on this area in the study mat or in the revisionary test papers or in the education material. So I just took my own example to elaborate this concept to you. Okay, now let's go on to the second area of discussion, and that is looking at joint and byproducts. Now, here I'm going to remind you the concepts you've done at your CA intermediate level. So, I think I need to first connect you to the concept of the cost accounting and then bring you back on Ind AS 2. If you remember, there was a concept in intermediate joint and byproducts. Now, what was that concept? A company is jointly producing two or more than two products simultaneously. I repeat, a company is processing two or more than two products simultaneously in a particular process. Now, what can happen? There are two cases. Let's say if you're manufacturing three products together, it could be a situation that all three are supposed to be joint products. And number two, it could be a situation where some of the products are main product and the other products are called byproducts. Now, I think before I read the para number 14, I think I'd like to take you back to the concept what you've learned in the intermediate level. So let's, I think, first of all, visualize something to you. So I am looking at, let's say there is a particular process. What a perfect square. So let's say there is a particular process and you are simultaneously producing three products A, B as well as C. Now there are two possibilities. Number one, let's say we say that A, B as well as C are supposed to be joint products. So let's say that all these three products are supposed to be a joint product. So do we need to also recall that when these products are classified as a joint products? Well, I don't think so. I think this status, whether they are joint products or they are main or byproducts, would be very clearly given to you in the question itself. And let's say there is another situation where we are saying, let's say out of them A and B are supposed to be main products. And let's say as far as C is concerned, it is supposed to be a byproduct. So these are the two kind of situations we can confront, that either the products are called joint products or they are supposed to be a main and byproduct. Now, if you further recall in terms of main and byproduct, there were two kind of situations. One is, we used to say that the byproduct is material in nature. And the other is, we used to say that the byproduct is supposed to be immaterial in nature. So there used to be two cases. One is, we used to say that the byproduct is material in nature. Now let me remind you, what was that concept? When we say that ABC are joint products, we say that the economic value of ABC is almost equal. So each one is got a good economic value. So they're supposed to be joint products in nature. But when you say, let's say A and B is higher economic value and C is not that higher economic value compared to A and B. So we're saying C is not that high economic value compared to A and B. Then we say A and B is the main product and C is the byproduct. So C becomes a byproduct when you compare it to A and B. But otherwise, independently, C may be having a good economic value. So once we zero down that A and B are main product and C is a byproduct because C compared to A and B is not of that high economic value. But otherwise, it might be material in nature. So there used to be two cases that either we say that the byproduct is material or we say that the byproduct is immaterial in nature. Now, if you recall further, once we say that the byproduct is supposed to be material in nature, we used to treat the main and the byproducts as good as joint products. When we used to say that the byproduct is material in nature, so we used to say that let's follow the same concept which is applicable to joint products. But if they are immaterial in nature, then in that particular case, we used to say that let's treat them as good as scrap. If the byproduct is supposed to be immaterial in nature, then we used to say, let's treat it as good as scrap. Now, let me remind you further what we used to do in cost accounting. So in this particular case, let us say the process in which ABC are simultaneously processed is got a GPC, that is a joint processing cost, let's say to the extent of 10 lakh. Now, what we used to do in this particular case, let's say if ABC are joint products, you will divide this 10 lakhs between ABC in the sales value ratio. I put that again. So you know that there is a joint processing cost which is, for processing ABC together. So if you want to allocate this GPC between ABC, we simply do it in the ratio of sales value of ABC. In the second case, if A and B is the main product and C is the byproduct, but it's material in nature, then also the 10 lakh rupees of GPC is allocated to ABC in the ratio of sales value. So which means whether ABC are joint products or A and B is a main product and C is a byproduct but material in nature, you do the same accounting treatment. That means that JPC is allocated in the sales value ratio. But if you look at the third situation where A and B is the main product and C is the byproduct which is immaterial in nature, then in that particular case, what we do, we consider C as good as scrap. So what we used to do from this 10 lakh rupees, we used to reduce the NRV of C. From the 10 lakh rupees, we used to reduce the net realizable value of C, and whatever is the net figure that is allocated to A and B in the sales value ratio. So this is what I'm reminding you in terms of cost accounting, and trust me, the Ind AS 2 talks of the same concept in terms of joint and byproduct. So but in a nutshell, let me tell you one thing, that there are a total of three kind of situations. You need to first of all zero down on the fact that is the question talking on joint products? Then the JPC is allocated to all three in sales value ratio. Situation number two, if you say it's a main and byproduct, you need to zero down, is the byproduct material or immaterial in nature? If it is material, you do the same treatment. The JPC is allocated to main and byproducts in sales value ratio. But if you say that C is supposed to be immaterial in nature, then you get a net JPC. What do you mean net JPC? From the total JPC of ABC, you reduce the net realizable value of C and the remaining net cost is allocated to A and B in sales value ratio. I know the next question which might be coming to your mind is, sir, the question would be very clear whether it is a joint product or it is a main and byproduct, but would the examiner tell us that the byproduct is material or immaterial in nature? So let me tell you, unless mentioned otherwise, don't worry, the notes would come later. Unless mentioned otherwise, we will always assume that the byproducts are immaterial in nature. And in fact, when I'm going to take you back on Ind AS 2, you'll see the language very clear, that it says very clearly that most of the byproducts are immaterial in nature. So we're going to go with the presumption, unless mentioned otherwise, that all the byproducts are supposed to be immaterial in nature. I think now it's time to bring you back on the text of the standard. Let's have a look at the para number 14. And I think with this para number 14, we will then also give you some notes. Then we'll also do one of the questions which came in the old course in the exam. Now, this question is also in the study material in the new course, but it came long time back in the old course in CA Final Financial Reporting. Let's have a read on the para number 14. A production process may result in more than one product being produced simultaneously. This is the case, for example, when joint products are produced or when there is a main and a byproduct. So he's given you two situations that when you simultaneously produce, more than one product, either it results in joint products or it results in a main and a byproduct. Then he says when the cost of conversion of each product is not separately identifiable, they are allocated between the products on a rational and consistent basis. Now, as you remember, in the intermediate, there were a couple of methods which were used in terms of allocating the JPC, like the physical measurement method, like the market price method, the variations in the market price method in terms of sales value at splitter point, in terms of sales value after further processing, in terms of NRV, and the list goes on. But from the point of view of the examination for Ind AS 2, we will apply the concept of the sales value ratio. As you can see, the para number 14 further says the allocation may be based, for example, on relative sales value of each product either at the stage in production when the products becomes separately identifiable, it's like the splitter point, or at the completion of the production, it's like taking the sales value after further processing. Now, he says further, most byproducts by nature are immaterial. It says most byproducts by their nature are immaterial. When this is the case, that's the reason I said unless mentioned otherwise, I'm going to presume that these byproducts are supposed to be immaterial in nature. It says when this is the case, they're often measured at NRV. And this value is deducted from the cost of the main product. So very clearly what I said, that you will take the JPC and you will reduce the NRV from the JPC. As a result, the carrying amount of the main product is not materially different from its cost. So my mind is now working on three different kinds of permutation combinations, and I think I want to make a note on that. And then I think we want to see that in terms of a practical illustration as well. So let's do one thing. Let's, I think, first of all, make some notes to you. So we have a clear-cut idea in terms of what accounting treatment are we going to apply in all those three permutation combinations. And I'm just going to add a small little thing also in the notes, which is a pretty easy concept. So let's give the heading special issue number 2. So let's give the heading special issue number 2. And the special issue number 2 is dealing with joint and byproducts. It deals with joint and byproducts. And we can divide this in two sections. One is, it is a case of a joint products. And one is, it is a case of main and byproducts. So either it would be a case of a joint products or it would be a case of a joint and main and byproduct. Now, if it is a case of main and byproducts, then there are two situations. Either we say that the byproduct is material in nature, or we say that the byproduct is supposed to be immaterial in nature. And I think in the brackets, let me make a mention, unless mentioned otherwise. So if the question is silent on the agenda, then you can safely give your assumption to the examiner that we are assuming that the byproducts are immaterial in nature, unless anything to the contrary is stated in the question. So if it is a case of joint products, you know what you're going to do? You will take the JPC minus the sale of scrap, if any. Oh, so this is the addition. Yes, this is the addition. Because the examiner would also at times give you information about the scrap of the sale value of the scrap. So we need to remember that that's a normal concept, that from the JPC, you need to reduce the sale of scrap, if any, and whatever is the net value which you're going to get, this net value is going to be, you can say, allocated to, this will be allocated to, let's say, joint products, allocated to the joint products in sales value ratio. So we will allocate this to the joint product in the sales value ratio. Okay, now let's have a look. If it is a case of a main and a byproduct, and we say the byproduct is material in nature, trust me, we're going to apply the same concept altogether. That means from the JPC, I will reduce the sale of scrap, and then the net amount is allocated to the main and the byproduct. The main and the byproduct in the sales value ratio. But when it comes to the case when it is immaterial in nature, we would consider the JPC minus the sale of scrap, if any, minus the sale of scrap, if any, which of course may or may not be given in the question. And from this, we will also reduce, remember, not the selling price, but the NRV of the byproduct. So we need to carefully calculate the net realizable value of the byproduct, and we will get this net figure. And this net figure is going to be allocated to main products only. It is allocated to the main products. I'm putting it as MP. It is allocated to main product in sales value ratio. It is going to be allocated in the sales value ratio. And trust me, there cannot be any permutation combination apart from these three combinations what we're looking at. And I think once we are able to do a question, I'm sure it's going to give you a little more clarity in terms of things. So let's, I think, go to a practical question related to this. So here is the question, and you can see that we are covering the aspect 2, which I called it as a special issue number 2. And this is based on the concept of para number 14. And incidentally, you can see that this question also came in the mock test papers in 2018. Though this question, as I said, is also come in the CA final old course. And now I think I'm waiting when it's going to find its place in the exam. And I think sometimes, I get a little more excited looking at the question. And I feel, the best way to put this question to the people would be that, you are given three parts. Assume that the main and the byproducts are, let's say, byproduct is material. Assume it is immaterial. The examiner tells us to do all the possible permutation combination. Sometimes sounds dangerous. Okay, let's have a look at the question number 9. It says in a manufacturing process of M, one byproduct emerges besides two main products apart from scrap. I'm pretty sure as you're reading the language of the question, there should be a clear-cut thought going at the back of the mind. That number one, it's a case of main products and byproducts. And then he says there is a scrap as well. So we know that we need to reduce the sale of scrap from the JPC in any case. Then he gives you the details of the cost of production, in which I am given the material, the wages, the variable and the fixed overheads, and I'm given the outputs of MP1, MP2, main product 1 and 2, and the byproduct. We're given the closing stock of the main products, but we're not given any closing stock of the byproduct. Then in the additional information below, he gives you the market price of MP1, MP2 on a per unit basis. And then he says that the byproduct is sold at the rate of 20 rupees per unit. Then he says there is a profit of 5,000 on sale of the byproduct after incurring a separate processing charges. That is 8,000, and there is a packing charge to the extent of 2,000. Then he also tells you that 5,000 is realized from the sale of the scrap. The requirement of the question is to calculate the value of the closing stock of MP1 as well as MP2. Now, as you can notice in the question, no way he is telling you that the byproduct is material or immaterial in nature. And I've already said that unless mentioned otherwise, I'm going to assume that it is immaterial in nature. But there is another supporting point to my viewpoint. If you notice in the question, I am not given any closing stock of the byproduct. I mean, that would also be some way or the other an indication that the company is, not treating it as a finished product. But in any case, I think the best way is always to assume and give the assumption to the examiner that we are assuming that as far as the byproduct is concerned, it is immaterial in nature. So I think once we've decided that it is a case of main and byproducts and the byproduct is supposed to be immaterial nature, your mind should now start working on that I need to calculate number one, the JPC. That's like the working note number one. Second, I need to organize the NRV of the byproduct. So with the two working notes, I'll be able to get my net JPC. So I think let's focus on the two working notes and then we get the net JPC, and then I think the rest of the things would follow where we're going to divide that net JPC in the sales value ratio of MP1, MP2. So I think let's begin the journey to question number 9. So let's start solving it. And we need to be very good in terms of presenting our skills on the solution as well, because your working notes need to be very clear to the examiner. So we will start with the working notes itself. Many people at times, ask me, sir, is it a good idea to start with working notes? Of course, yes. I don't see any challenge in the exam that if you present the working notes to begin with, because at the end of the day, your working notes are the main things which is going to fetch you marks. So you can always start with the working notes. So let's begin with the working notes with you. So we are looking at the working note number 1. And here we're looking at the computation. Here we're looking at the computation of JPC, not the net JPC. First, we're looking at the total JPC. So I think I need to get back and have a look at the data in the question. We've got material which is 150, wages which is 90. Let me first note it down. So we've got raw material which is 1,50,000. We've got wages which is to the extent of 90,000. Then I think we can take the variable production overheads and we can take the fixed production overheads as well. And that's, I think, variable is 50,000 and fixed is 65. So this is 50 and this is 65. So I think we can conveniently get what is the JPC in totality. And I think this is coming out at a total of 3,55,000. So that is my first working note where it gives me what is the joint processing cost. Okay, so now we can go to the second working note as well. And let's create the working note number 2. And that is in terms of computation. The computation of NRV, net realizable value of byproduct. So we need to get the net realizable value of the byproduct. Now, when you're looking at the NRV of the byproduct, your mind needs to be very clear that when you're considering the net realizable value, you should be clear what is the formula for calculating the NRV. Though I have not yet discussed with you how the net realizable value is taken, but I'm pretty sure with your knowledge at the intermediate level, you would recall that the net realizable value is supposed to be the estimated selling price, and from the estimated selling price we reduce two things. One is the estimated cost of completion. One is we reduce the estimated cost of completion, and the second thing what we reduce is the estimated cost necessary to make sale. Estimated cost necessary to make the sale. Sir, you're reducing the estimated cost of completion, but that is reduced only when you calculate the NRV of a WIP. So are you treating this byproduct to be, something which is like a WIP? Of course, I am doing that. I think if you look at the language at the end, you would see something which is clearly given. There is a profit on sale to the extent of 5,000 after incurring separate processing charge. That means the byproduct which emerged out of the first process was further processed in another process. And if it was further processed, that means it is in an incomplete stage. So once it is produced from the process number one, it was further processed and then sold. So in this particular case, we can certainly say that it was in a WIP stage when it was produced from the first process. So he says that 8,000 is the separate processing charge, which is like the estimated cost of completion. And he also tells you that there is a packing charge of 2,000, and that is a cost which is necessary to make the sale. So if we say that that is a cost which is necessary to make the sale, then in that particular case, we reduce the 2,000 as well. And then we're also given the selling price of the byproduct. It is sold at the rate of 20 rupees per unit, and there are a total of 2,000 units of the byproduct. So I think let's do that. Let's go back to the calculations. So we can say in terms of the estimated selling price, it is 2,000 units with a selling price of 20 rupees per unit. That works out at 40,000. The estimated cost of completion is 8,000, what we just read, and the cost necessary to make the sale, which is the packing cost, is supposed to be 2,000. So we get a net realizable value which is to the extent of 30,000. And once you've been able to organize the net realizable value of the byproduct and you've able to organize the JPC, now we are ready to get the net JPC as well. So I would say now the main solution begins. These were the two working notes. Now we're going to go on to the main solution where we're going to see what is the net JPC which can be allocated to MP1 and MP2 in the ratio of the sales value. So let's do one thing. I think first of all, calculate these so we can show the computation of. This is not the working note. This is not the main solution. So computation of net JPC. Oh my God. It automatically sometimes, if you not careful with the words, makes a square as well. So computation of the net JPC. There is a lot of artificial intelligence which takes place in a lot of things, including this. So I have seen, sometimes when you're trying to connect words, the computer does something really crazy at times. And, my T was joining the E, so it immediately said, I'll make you a square. And, when it makes it a square, sometimes it messes your work as well. Okay, so we said computation of the net JPC. So we have in the working note number 1, let's give the reference working note number 1. You've calculated the JPC at 3,55,000. I think let me just ensure the figure correct. That's right. So 3,55,000 is the JPC. And from this, we need to reduce the NRV of the byproduct. So we need to reduce the NRV of the byproduct, which is from the working note number 2. And that's what we calculated to be 30,000. And then finally, we also need to remember that there is a sale of scrap also. And I distinctly remember it was 5,000 rupees, which was given at the end of the question. So once you take this net value, I think that works out at 3,20,000. So this is the net joint processing cost. And now I think on this particular basis, we need to split this in the sales value ratio. So we need to organize the information further. And we would now organize 3 columns. One is particulars, and one is MP1, and one is MP2. That's the main product 1, and that's the main product 2. Now we need to organize the sales value ratio. So let's consider the number of units, and we're going to multiply this with the selling price per unit so that we can organize the sales value of both the products. And then we can conveniently divide that 3,20,000 in the sales value ratio. So I think let's get back and see what is the number of units. MP1 has got 5,000 and MP2 has got 4,000 units, and the price is 60 and 50. So 5,000 and 4,000. 5,000 and 4,000 units, and the selling price is 60 and 50. So I think this works out at 3 lakhs, and this works out at 2 lakh. And you know what? There is another caution which one needs to be careful at this particular stage. Sir, at this stage, what is something which is going to bother us at this stage? There is another very interesting concept you should look out. If I were to alter this particular question, I would have altered the question in such a way that people would have got slightly confused. The question is that when you're considering the units out here, are you going to consider the units to be, are you going to consider the units to be the units sold or the unit produced? Now you would say, sir, if you are calculating a sales value, the sales value is going to be taken on the basis of units sold. And the answer is no. You will consider the units out here to be the units produced. You need to consider this to be the units produced. The JPC is incurred on the basis of the units produced. And if you've taken that on the basis of the units produced, then in this particular case, you need the sales value of the unit produced. So if I were to create a variation in the question is giving me the output of MP1, MP2. I would have given you the units sold of MP1, MP2 and the closing stock of MP1, MP2. And the moment you know that this is the unit sold and this is the closing stock, you can just calculate the production. So be careful that when you are allocating the net JPC between the main products or the joint products, you need to consider the sales value of unit produced always. So that was another interesting catch. So what we need to do, we need to now divide the JPC, that is 3,20,000, and this is to be allocated in the ratio of 3:2. So let me divide 3,20,000 in the ratio of 3:2, and that works out at, this is 1,28,000, and this is going to be 1,92,000. So we've been able to allocate the JPC between the two products. And in order to calculate the cost per unit, you're going to divide this by the number of units as well. And I think we've just seen the number of units above. That is, the units produced is supposed to be 5,000 as well as 4,000. And on this basis, we can calculate the cost on a per unit basis. And I think once you get the cost per unit, I think my job is now pretty simple because all I need to do is multiply the cost per unit into the closing inventory and get the stock valuation. So the cost per unit comes to 38.4 and the cost per unit out here works out at 32. So now with this, we can easily calculate the closing stock. So we can make another small little separate note. It's a part of the main solution. So we're looking at the valuation of closing stock because that is the main requirement of the question. So in case if you want the above computation also to be represented as a working note number 3, I think one can fairly do that. The valuation of the closing stock becomes the main solution. So you get a working note number 1, which is JPC, the working note number 2, which is the NRV or the byproduct, the third working note, which is, the allocation of the net JPC between the main products. So I think I'm taking the same columns MP1 and MP2. And in this particular case, we know the number of units in the closing stock and we know the cost on a per unit basis. We can conveniently calculate the closing stock. So this is 38.4 and this is 32. And we can get the closing stock is 250 and 100 units respectively. So this is 250 and this is 100 units. So that works out at 3200 and this works out at a figure of 9600, I guess. 250 into 38.4, that's right, it works out at 9600. Super. So I think it was a little lengthy exercise. You might have felt that this was, took a little time to do such a kind of questions. And you must be wondering that how many marks could this kind of question come in the exam? Well, if you ask me, frankly speaking, I think this question would not get a weightage for more than 6 or maximum 8 marks in the exam. Though I think 8 marks would be slightly on the higher side. I would say that 6 marks would be, the case. Because right now I was explaining a couple of things of how to present as well. But otherwise, I think fairly one would do this question in almost around, I think, 10 minutes in the exam. So I think fairly it should not be more than, 6 marks. And how do I look at this analysis? You got to attempt a total of 100 marks in the exam in 3 hours, which averages out to almost like 33 marks in a 1 hour's time. So if you consider that it takes almost like 15 minutes, then it should be 8 marks. And if you consider, let's say it is around a 6 mark, then it should take on an average 10 minutes. So that is how this psychologically fits in. Now you must be thinking, is that the same psychology the examiner applies in terms of setting the paper? No idea. But I think it should be. Sounds logical. Isn't that so? Okay. So I think with this inputs now, we are ready now in order to go to the next issue with you. So let me remind you back. As I said, we've got a total of 3 agendas today discussing these special issues related to cost. So I have done with my first agenda, and that is in terms of the deferred credit terms. I've done with them a second, special agenda in terms of joint and byproducts. Now I am coming to a very interesting third agenda. And that third agenda is in terms of looking at a cost formula. Now I'm going to remind you back what you did in CA Foundation. So the interesting part seems to be you're teaching for the CA final. A couple of minutes back, you were talking in terms of reminding at CA intermediate. Now you're looking at reminding us in terms of what we did in CA foundation. Are we actually studying CA final? We are. But those foundations which were laid in the CA foundation and in the intermediate is going to be in rescue at the CA final stage as well. Right. Now, I have a small little question, which is coming to my mind, and you need to vouch me very carefully on this. When a company measures the closing stock, is it measured on the basis of the cost incurred, or is it measured on the basis of the cost which should have been incurred? So, can you come again? We find that as a little weird question. I said, when you consider your inventory valuation, do we consider the inventory valuation on the basis of the cost incurred, that is the cost which you have actually spent, or do you consider the inventory on the basis of the cost which should have been incurred? If you don't ask this question to anybody, everybody would outrightly say inventory will be measured at what you incurred. Why are you talking in terms of the cost which would have been incurred? I'll tell you the reason. Ind AS 2 allows you both the cases. Depending upon the circumstances, a company could measure the inventory on the cost incurred, what we call historical cost. The company could also measure the inventory on the basis of the cost which is supposed to be incurred, and that is what we call a non-historical cost. But I think before that, I need to show you something. Just hear this very carefully. We're going to make some notes later. As you can see, the para number 23 in front of you, where the heading is given a cost formula, and in terms of the para number 23, it talks of the cost of inventory of items that are not ordinarily interchangeable. I'm not reading further. It says the cost of inventory of items that are not ordinarily interchangeable. The $1,000,000 question which comes to the mind is, what do you mean by items which are not ordinarily interchangeable? Similarly, in terms of the para number 25, it says the cost of inventory other than those dealt in para 23. That means we're looking at inventories which are ordinarily interchangeable. Well, what I understand out of the para number 23 and 25 is the focus is the inventory ordinarily interchangeable or is it not ordinarily interchangeable? But the basic question is, what do you mean by that it is ordinarily interchangeable or not? I'll tell you. Many a times if you go to, for example, let's say a departmental store. Now you would see in a departmental store that there are various kinds of products. Like for example, you look at biscuits, there might be 10 brands of biscuits. Now in this particular case, you can say that these are inventories which are ordinarily interchangeable. Now let's say for example, if you go to, a company, let's say you go to a jeweler, then people would actually select a jewelry set and they would say that I want this jewelry set. He would not go, for one design against the another. The designs are different. Indirectly, in simple words, I can say that when inventories are tailor-made to the needs of the customer, mind the words, when the inventory is tailor-made to the needs of the customer, in that particular cases, we say they're not ordinarily interchangeable. But when the inventories are not tailor-made, a consumer could settle for one brand against another brand. Like when you're looking at biscuits, you're looking at, let's say, shampoo, you're looking at, let's say, any kind of normal FMCG products. So in those particular cases, the inventories are ordinarily interchangeable. So when you're looking at the valuation of inventory, we need to first of all consider, is it ordinarily interchangeable or is it not ordinarily interchangeable? So the key issue with which you're going to decide this is, you will first of all put across a question to yourself. And we will say, first of all, is it a tailor-made product? If you say it is a tailor-made product, then I'll say it is not ordinarily interchangeable. And if it is not a tailor-made product, then in that particular case, we will say that it is supposed to be it is supposed to be ordinarily interchangeable. So in terms of inventory, we need to first of all zero down on the concept that is it ordinarily interchangeable or is it not ordinarily interchangeable. Now, once we decide that it is ordinarily interchangeable or it is not ordinarily interchangeable, we need to see which method would apply. I think let me go back to the para number 23 and let's, I think, take a small practical example as well. If you remember, if you anytime went to a jewelry shop, you would see in terms of the jewelry shop that there is that jewelry set and there is a small little thread attached to that set and there is a small piece of paper which gives you the specifications regarding that jewelry set. How much carat of gold, or is there any specific number? So you would see some identification numbers, some coding which is done on that piece of paper. As per Ind AS 2, we call this as SIM. I'm not looking at that phone SIM, it's called a SIM, that is called a specific identification method. If you look at the para number 23, it very clearly says inventories that are not ordinarily interchangeable and they are produced and segregated for specific projects. As I said, tailor-made, shall be assigned using specific identification of their individual cost. The company would always have a record of whatever cost is incurred on that specific project, and this is called a specific identification method. So in these particular cases, when the company is dealing with inventories which are not ordinarily interchangeable, which is a tailor-made inventory, we use a technique called a specific identification method. So when you sell that inventory, you know that what is the cost incurred in manufacturing or producing that inventory, and accordingly you would book a cost and the revenue against it. Fortunately, unfortunately, there is no question which has ever come in the exams relating to para number 23. Even in terms of IGAP, there has been no question. And I don't see any possibility of this coming in the exam as well, because if you are asked what is the cost assigned to that particular inventory, then it becomes a normal question of finding out what is included and what is excluded from the cost. Because you need to basically identify that what is the cost incurred, specific to that particular project. So it becomes a normal question, what we've already covered. Then it comes to the fact in terms of para number 25 that when we say that the inventories are not tailor-made, then we say they are supposed to be ordinarily interchangeable. Then the para number 25 very clearly says that we will use a first in, first out or a weighted average formula. Now, there was another thing which I said and I've not yet answered. The question is, do we consider inventories at the incurred cost, that is historical cost, or do we consider inventories at the cost which should have been incurred? So I think in connection to the para number 25, I need to also show you another input in terms of para number 21. Technically, the para number 25 is to be read with the para number 21 itself. And if you see in para number 21, it says techniques for measurement of cost, such as standard cost. What is standard cost? Standard cost means the cost which should have been incurred. It is not a historical cost. It is supposed to be a non-historical cost. So it says the techniques for measurement of inventory, such as a standard cost or a retail method, may be used for convenience if the results approximate the cost. So I would put it like this, hear me very carefully. My mind is now working on a little chart like this, that there are two cases. The first thing I'm going to ask, is the inventory ordinarily interchangeable? I say no. Don't worry, I'm going to make the notes very soon. So I put across a question that is the inventory ordinarily interchangeable? I say no, it's a tailor-made inventory. So I said, okay, you got to apply SIM, specific identification method. You said no, it is not ordinarily interchangeable. Then I said you've got a choice in terms of historical method and non-historical method. You need to preferably always measure the inventory using historical cost method. We would always consider inventory on the basis of the cost which is actually incurred, which is a historical cost. Then when do we use a non-historical cost method? The para number 21 makes it clear that the non-historical cost method may be used for convenience. So it will be used for convenience, but there is a precondition that if the results approximate the cost. Before I explain further, I remember a couple of years back, I saw a particular question somewhere. I don't remember the source now, but I read a question, and that question is coming to my mind at this stage, which I want to share it with you so that I can elaborate the concept of the para number 21 further. The question said that the company measured the actual cost and identified that the actual cost is supposed to be 800 rupees per unit. The historical cost of the inventory is 800 per unit. And they said that when we calculated the standard cost of the inventory, that is also coming to 800 rupees per unit. So they said that since the standard cost approximates the actual cost, the company is of the view that we should be allowed to measure the inventory at a standard cost. I repeat it back again. The facts of the question said that the actual cost, the historical cost of the inventory is 800 and the standard cost of the inventory is also 800. And they said that since the standard cost approximates the actual cost, the company says that we should be allowed to use a standard cost. And then it said, as an auditor, what is your opinion? Should the company be allowed to use a standard cost or not? And the answer was no. The answer was a no. And you would say, so why? You would say, so if you go back to the para number 21, it clearly says that it may be used if the results approximates the cost. And if the results is approximating the cost, then why should a standard cost method not be allowed? But then it also says that it is used for convenience. If you can measure the historical cost, then you don't need any kind of convenience in life. So this indirectly means that you should have a trouble in terms of estimating the historical cost. So if you remember, your old days in CPT, in CA Foundation, one used to apply a technique called a retail inventory method. I think I'd like to remind you what was the concept of that retail inventory method as well. Now, let's, I think, recall something which we did earlier. So, if you remember, I'm taking you back on the CPT days when, we used to do something like this. We used to actually say that there is item A, there is item B, there is item C, D, and E. So let's say there are a total of 5 items. So we used to say that let's say there is a total of 5 items. So what we used to say that if there are a total of 5 items, let us see the closing stock of all these items at a selling price. So we used to take the closing stock of A, B, C, D, E, all the 5, and we used to calculate the closing stock at selling price. And if you remember, from this closing stock at selling price, we used to reduce the average profit margin. We used to calculate that all these products are similar gross margins. So let's calculate an average profit margin on all of them. And we used to get the closing stock at cost. And you know what? We used to call it as a cost, but remember, this cost is not the actual cost. Because when you reduce the average profit margin of all the five products, then you're going to get the closing stock, which is, based on an average margin. So this is not the exact cost. So we can say this is indirectly, you can say is a non-historical cost. So we used to apply the concept of a non-historical cost method. And this is a method which is used in departmental stores. The companies in departmental stores, when they know that they've got similar kind of products with similar margins, because in each product line you'll have different brands of product, but they've got similar margins, so getting the inventory on techniques like historical cost might be very inconvenient for them. So they would always look into certain kind of convenience, and in terms of convenience, what they would do actually, they would apply the concept of a non-historical cost. So if you go back to the example which I was discussing, in this particular example, the company knows the historical cost. So if you know the historical cost, you need to first ensure that it is inconvenient to get a historical cost. So if it is inconvenient to get a historical cost, only then I would zero down on the application of a non-historical cost. But once you say that, yes, I'm applying a non-historical cost, you need to also prove that the cost, the non-historical cost is approximately equal to the historical cost. So like in the example below, when you club all the five products with a similar margin, and from the closing stock at selling price, you reduce the profit margin, you get the closing stock at cost price, which indicates what? That it is approximately equal to the historical cost. So we applied this technique for convenience. And when we apply this technique for convenience and we get the results approximate to the cost incurred, then we can apply this. Some moral of the story, I'll tell you what is the moral of the story in this particular case. So my mind is now working on a chart like this. I think draw a chart on the special issue number 3 with you. So we are on the special issue number 3. So, but do we get any questions on this kind of area? Well, unfortunately, till now, there have been no questions in the exams on this area, even in the old codes. But we can certainly expect, questions coming on this kind of area, because now these kind of questions have been added in the study material as well. I don't think that they've been put these questions only for giving us conceptual clarity, but I think we'll see them in the exams also. So that is the reason we're spending, time on this issue as well. So we can say that when you're looking at the cost formula, when you're looking at the cost formula, then in terms of the cost formula, we can say your mind should work on number one. Your mind should work number one, is the inventory not ordinarily interchangeable? Is the inventory not ordinarily interchangeable? So we're saying that the inventory is not ordinarily interchangeable, or we are saying it is ordinarily interchangeable. So we are saying that it is ordinarily interchangeable, or we are saying it is not ordinarily interchangeable. So how do we decide that it is ordinarily or not ordinarily interchangeable? So in this case, we are saying if it is a tailor-made product. Oh my God. I think, let me clear this. Triangles made again. So we can say in this particular case, if we are saying it is supposed to be a tailor-made product, If it is supposed to be a tailor-made product, then we say it is not ordinarily interchangeable. So apart from the tailor-made products, we will say they are all ordinarily interchangeable. If it is not ordinarily interchangeable, we use a technique called SIM, and that is what we call specific identification method. That is called specific identification method, because whatever cost is being assigned in terms of that specific product, we would know that. Now, when you say it is ordinarily interchangeable, then we can say we've got two aspects. One is we follow the historical cost, and the other is we follow the non-historical cost method. Now, when you say historical cost, it means the cost incurred. And when you say a non-historical cost method, it means the cost which would have been incurred. But you need to apply a non-historical cost method only when convenient. So your first preference will always be towards a historical cost method. It is only when the historical cost method, to apply a historical cost method, it becomes inconvenient. Like for example, in departmental stores, then we would apply a non-historical cost method. Now, when you apply a historical cost method, the cost formulas which we use is called a first in, first out, and is also we use what we call a weighted average method. So the technique of using a first in, first out and a weighted average is the application of the historical cost method itself. And in terms of the non-historical cost method, the standard has generally laid down two techniques. One is called RIM, that is called retail inventory method. That is called retail inventory method, and this retail inventory method is used. This retail inventory method is generally, as I said, used in terms of departmental stores. And it also gives you another technique which is called a standard cost method, where we consider the cost which should have been incurred and not what is actually incurred. So I guess this gives us a complete chain of thought in terms of the cost formula. You need to decide, is it a tailor-made inventory? Then it is SIM. If you say no, it's not a tailor-made product, then we say preference is to the cost incurred, which is the historical cost incurred. FIFO or weighted average, depending upon the facts of the case. And if it is convenient to apply a non-historical cost method, and what is important is yes, it is convenient, but we also need to ensure in this particular case that when you apply a non-historical cost method, we also need to ensure that the results approximate the cost. So if your results approximate the cost, then in that particular case, we can say we will use a non-historical cost method. So that was the special agenda for the day. So I am also going to take some questions on this area also with you, along with the next aspect with you in the part number 3, where I'm going to discuss the aspects in terms of NRV with you, and that would be the concluding part in terms of Ind AS 2. So today we have understood the special issues related to the measurement of cost. One is that when inventory is acquired on a deferred credit, then how do we account for it? How do we apply the unwinding of discount? Number 2, when we're looking at a case of joint and byproducts, how do we account for a joint and byproducts in 3 specific situations with you? And we also finally saw another inputs, and that is the application of the cost formula, which technique is to be applied in terms of measurement of cost. So that's all for the day, friends. So I'm going to meet you again with the part number 3 and the final part on the Ind AS 2 very soon. Till then, thank you, take care, and goodbye.